Yesterday was trading range day, or a triangle, or a bull flag and a breakout and a pullback, and then another breakout. Spike, possible channel up. Today opened above this channel with a bear close, so it may try to break back into the channel and test the bottom of the channel like yesterday. I don't want to buy above the high of this bar because at best it would be a scalp. I wouldn't buy it for a swing. I'd want to see more of a correction. As far as shorting goes, there is room to the close of yesterday. There's room to the moving average. It's a possible short. I personally did not short it because of the two-tick tail on the bottom. Possible that it could have sold off like yesterday. Yesterday had a one-tick tail and it had a scalp down. I decided to wait for more information. Second bar of the day overlapped the first bar a lot. One tick bull body. To me, I'm concerned that this looks like a sideways open. So I'm not going to buy above. So I'm still flat. Bar 3, another doji bar, so that increases the chances of trading range price action. You can argue that shorting below it is a little lower high in a second attempt down. You can argue buying above it is maybe a double bottom with the tail of bars 1 and 2. To me, I see 3 small sideways bars, and I need more information. Okay, a possible 2-bar reversal at 4, a bear signal bar, second attempt down. But again, 4 sideways bars, I think it's a risky trade. So yes, if the market went below 4, there might be a 60% chance that it would go down for a scalp, and maybe a 40% chance or 30% chance it could be the high of the day. Scalp, I wouldn't take it based on 60%. And the swing, I don't think this is a strong enough open for me to start swinging yet. I want more information. Buying above 4, thinking there might be trapped bears. I don't think that many traders shorted early on 4. So again, I'm stuck waiting. This is an interesting setup. I mentioned this at the time. 4 is barely a legitimate sell signal. So if 5 becomes the first bar of a 2-bar reversal, or if the next bar is an outside down bar, theoretically you could short as the market moved below 4, and that's what happened. So here you could either go short below 4 because 4 is a barely acceptable sell signal, little bear bar, or you could sell below the outside down bar. And as we know, most traders viewed a signal bar as the bar 6 low, and they shorted below there. And we know that because the market fell for exactly 10 ticks below that before rallying. And so in other words, most of the traders went for a 2-point short. Great looking entry bar. This could be the high of the day, and it could be a huge bear trend day. So I definitely like this. Good sized bar, no tail top, no tail bottom. There might be some buyers at the moving average. We broke back into the channel from yesterday. So, 2 chances out of 3 that we should poke at a minimum through the bottom of the channel. 1 chance out of 3 that we don't. And bar 8, I mentioned, was a problem for me. On strong bear trend days, I don't want to see a great looking bear bar and then hesitation. I want to see follow through. I want to see immediate follow through, urgency, people panicking to short. I can't wait to short. I got to get out of my longs. Oh, I'm missing this great bear. I got to start shorting. And that's not what we got here. And then we had hesitation again on 9, and I ended up getting out of the. I was going to swing, try to swing for 4 points, and I ended up getting out of the rest of my position on the shorts over here. To me, this is not a good-looking buy. It's a high 2, with bar 2 being the high 1, but we have 3 sideways doji bars. Little double bottom. You can argue 9 and 10 is a double bottom. But we've only had 1 real trend bar of the day, bar 7. Everything else has been sideways. So I'm hesitant to buy at the top of anything and sell at the bottom of anything. Possible failed high 2 on bar 11, but instead it went up. Didn't go up high enough for the bull scalps to be profitable. However, I was concerned that 12 was a good-looking bull body, and I don't want to see that if this is going to be a strong bear day. So at this point, I think it's not likely to be a strong bear day, and it's probably going to be some kind of a trading range day. and it may just stay small all day. There's an attempt by the bears to force it down again, but instead 10 through 13 became the final flag of the bear, and the market reversed up. You could buy above 14, but I did not. I wanted to wait. The market may be forming a double top bear flag here. There's an attempt for a double top bear flag or a low 2 short, but the bears couldn't sell it off sideways. Another attempt at a double top. Again, the bears couldn't sell it off. So now we've got a spike up, 10, 11, 12, maybe another one at 15, and now we have a high 2 above the moving average. I personally wouldn't buy it. We're in a tight trading range, and this could become a wedge bear flag. 20 tried to be a strong bull breakout and instead had a weak close, so that's bad for the bulls. It's a theoretical wedge bull bear flag short setup, but you know the market went above the 7 high, and if the bears were good, they would not have allowed that to happen. And they spent too much time hanging around the bar 7 high. You know, bar 12, 13, 16, 17, now 20. So that's not behaving like a bear trend day. So I think at this point it's a trading range day, and I don't want to short below a bar in the middle of a trading range day, and I don't want to buy above a bar in the middle of a trading range day. So I'm doing nothing right here. Okay, every day I do something that I think is really dumb, and this is it right over here. Okay, I mentioned bar 27 was a good risk-reward trade for a double bottom bull flag and possible drift up. The range of the day is small, so it probably will expand. I don't know if it'll double, but it will expand. And to me, the bears took a couple cracks at going down with 7 and 14, and both were met by buying. So I'm assuming the market's going to try to drift higher. My problem with this trade, what I did wrong was I first identified it as a risk-reward trade. And I tend to immediately dismiss risk-reward trades because you know you're buying them because there's a lot of reward, a little risk, and a low probability. But this one probably had a higher probability because of the 2 failed attempts to go down. So I should have bought either as bar 27 was forming and risking 2 or 3 ticks, or above it as a little wedge bull flag. And that was my one dumb thing of the day. 30 broke out to the upside. At this point, I think the market's always in long. You know, you could argue that the bears might allow the market to go above bar 7 one time, but they should not allow it to go above bar 7 twice if they're any good. So I think the market's probably always in long, and that means traders will be buying below bars. 3 pushes up with 12, 20, and then now 31. But I think the market is probably going to try to work up, probably get a measuring gap here between the 28 high and the 31 or 32 low. Now the 32 low. I thought the day from here was, you know, it was very unusual, but it was also very interesting. The pullbacks were all small, you know, 4 ticks or so for the most part. As soon as the market went 1 tick below the low of a prior bar, they bought it, and they just did that for you know, at least a couple hours. That to me means the buyers are very strong. They're buying not only at the low of the prior bar, they're buying 1 tick above the low of the prior bar, and they all want to buy a pullback. I think the strong bulls really want a pullback, and they want to load up, but they're not getting a pullback. They're afraid of missing the move, so they have to buy something. And they keep trying to buy something at the low of the prior bar or a tick above the low of the prior bar. They want that pullback, but just in case it doesn't come, they're going to keep nibbling all day long. And the bears are looking for a good sell signal. However, there's no prior bear strength, so the strong bears are not shorting. So you know, you got the bulls just nibbling all the time, and you don't have anything that makes the strong bears want to short. So the market is just slightly one-sided, and it's enough one-sided for it just to keep drifting up, drifting up, drifting up. You know, so what about selling below 34? It's a bear bar. Selling below 39, it's a bear bar. Or if it's IOI, selling below 41. 41 has that big tail. I'm not going to short. The biggest pullback has been 8 ticks, and in the past hour or so, the biggest pullback has been 4 ticks, 5 ticks, I guess, at the low of 40. So there's no way I'm shorting below the low of a bar, because the chance of being able to get a successful short is tiny. And just look at all the other attempts. Look here at 13, 5-tick failure. 21, 4-tick failure. 31, 33, just 1 tick down. 39, 1 tick down. To me, you can't be shorting below the low of bars when the strong bulls just keep buying at the low of the prior bar. So to me, the only thing you can do is buy at the low of the prior bar, or 1 tick above the low of the prior bar, or wait for a pullback to buy, or wait for a sharp move down and then look to sell a second entry, a lower high or a higher high. I think those are the only 3 things that are good to do here. I also don't want to be buying above the tops of bars because the channel is so tight, and just look. So if you bought above 35, right, and then you see the bear bar at 39, are you going to keep holding your long? It's a 5-tick failure and a bear reversal bar, possible small final flag. You're not, and that's one of the problems in days like this with buying above the tops of bars. The people buying above the tops of the bars just keep getting stopped out. Okay, another possible top here at 46. 46 is a bear bar. 47 went above, so now you have a 2-bar reversal, possible little final flag. But again, no prior bear strength. And in the absence of prior bear strength, there's no way I'm going to short below the low of a bar. Especially with the bulls buying constantly. Look, 1 tick down here, they bought 1 tick here, they bought 1 tick here, 1 tick here, 1 tick here. They're not letting the market go down. And they bought again here. Tight trading range. But again, every attempt to push the market down leads to higher prices. Okay, decent looking bear reversal bar here at 57. Possible final flag in the area of 40 to 50 or so, but no prior bear strength, and the signal itself is not wrong. So to me, the market is still going to go up until I see a strong move down and then a test of the high. I'm not going to look to take any shorts. Okay, they keep buying. Okay, 3 little pushes up here, a little micro wedge. 54, 57, and 59. Little doji bar. Is it a short? I think, again, without any prior bear strength, I'm not looking to short below the low of any bar. I will short above the high of a bar. In fact, I did do a small short up here, but I'm not going to short below the low of any bar. This is also a 20 gap bar buy setup possibly taking place. The move up from 30 or so to 59 is in such a tight channel that, and it's going on for so long, that I think it's fairly unsustainable behavior. It's atypical behavior. Any atypical behavior is unsustainable. But that Keynesian comment, it can continue to be irrational and unsustainable longer than you can maintain your account is true. So just because it's unsustainable doesn't mean it's going to end on the next bar or the next bar. It can keep going, it can keep doing, it can keep living at the very extremes of the bell curve for a lot longer than you think. In any case, there was the 20 gap bar buy at 61. That was probably another mistake. I probably should have bought it since there was no clear top. My concern was I thought there might be a 2-legged pullback, and ultimately there was. But since the odds of the market going up were high, I probably should have bought it and just used maybe a 2-point stop and just walked away and then come back an hour or 2 later. Market drifted up 5 ticks. Now you get a 5-tick failure and a higher high after a minor trendline break. 61 broke below the channel, and now we got a double top, 2-legged double top at 66. So technically, it's a possible short. It's also an exact measured move up from the low of the day to the open of the day. but it's not a good enough signal bar, and the sell-off was only 5 ticks. You know, when looking for prior bear strength, I want to see a prior bear trade where the bears made a profit, and you know, they had a 5-tick failure on the 61 short, so I'm not shorting the double top. The bears tried to do it with bar 69, but they failed. Now we have a double bottom with 61 and a double top. You know, I don't know if either is going to work or if both will work. Sometimes both work. Sometimes it breaks out one way and then reverses and goes the other way. 70 is an EMA gap bar and a double bottom. It's the first bar with a high below the moving average in several hours. So technically, it's a buy signal. To me, more than anything, it's a buy signal because it's 8 ticks down, and that's as big a pullback as the market has had in over 4 hours. Market tried to pop to the upside, got a 9-tick failure, 2-bar reversal at 74, but the big tail on the bottom, I wouldn't short it. And with 72 and 73 as good as they are for the bulls, I think the market is trying to form a breakout pullback buy setup. To me, I would look to buy a pullback, and instead we went sideways, and the 70 longs finally got their 2-point long into the close. I think Monday is potentially, you know, interesting. We got this steep bull channel, and in my mind that's breakout mode, and we could break below it. Depending on the news over the weekend, we could have a big gap below it and a big sell-off, or we could break to the upside. In general, whenever you have channels that have been going on for a long time, if they break to the upside, usually they only go up for, you know, 1, 2, 3, 4, or 5 bars before they turn down back into the channel. And when they do, they usually test the bottom of the channel. One issue you have is what channel. And to me, the channel that I would be thinking about going into Monday would be this tight channel. So if it gaps above the channel and turns back in, my first target would be a poke below the bottom of the channel. But you know, we'll have to see. This is, you know, this is a very impressive rally. There's the daily chart. Looks like it's screaming upward. There's a measured move. I don't know if I have this one exactly correct, but there is a measured move based upon the head and shoulders bottom. You get several choices. You first use the smallest projection, which would be the right shoulder, and then the next projection would be the move up to the neckline from the head. And if it goes higher, then you use the highest leg of the head and shoulders pattern. And I don't know if any of those would work. We also have that measured move based upon the crash. I have to adjust it because of the rollover. Anyway, you know, I'm always, anything that's unusual always fascinates me, and so this fascinates me. Let me just take a look at that chart that I've been playing with. You know, where I just try to put had it gray below the moving average. You can just see that every time it came into the gray, they bought it. Just kind of highlight the moving average. All right, hope everybody has a good weekend.